For the first time in 15 months, Fed Chair Jerome Powell decided not to raise interest rates. The Fed has instead chosen to hold rates steady, but signaled it will raise them again next month if inflation doesn't come down further. This decision comes after the release of mixed economic data. On the one hand, inflation appears to be slowing. On the other hand, the job market is still very hot. US employers added nearly 350,000 jobs in May, and the unemployment rate still remains near historic lows. Despite the pause, policymakers expect 2 additional quarter-point increases this year, and that would lift the Fed funds rate to a target range between 5.5 and 5.75%. Scott, the market had priced in a pause this month, and Jay Powell delivered. Was that the right move?
I think so. I'm just heartened that there's really bright, high-character people like Chairman Powell to handle this shit. It's really interesting because if you go one level down, if you go to the president or representatives or the Senate, we get a lot of crazies. Mm-hmm. When it comes to the Treasury Secretary or the head of the Fed, it's as if everyone says, okay, playtime is over. We need an adult. Secretary Yellen is an adult. And even the president, as partisan they are, they usually leave that person in place. Some of it's because they're appointed for longer tenures. But I think what they're saying is, okay, there's partisan politics, there's even laws, and then there's the economy, and this shit's for real. We need to have really thoughtful people who don't scare that easily. So you're right, the market was expecting a pause. I think he's probably a little bit freaked out about what happened at SVB, and everything's heading his way. Stuff's heading the right direction, so I don't think he felt a need. I feel as if he thought he could take his foot off the brake, if you will.
Well, the point you bring up about there are no crazies in this position, I think that's just a function of the fact that the Fed chair isn't democratically elected. The Fed chair is appointed by the president. And usually when you have those appointments, sort of like what the China government does with a technocratic, authoritarian style of governing, you get less crazy people. But putting all that aside, just to provide some pushback against his decision, I think some officials favored a hike. And the argument was that, we've been hit by these data surprises, specifically the higher job vacancies. There's more employment creation happening. There's also the fact that the debt ceiling is suddenly not an issue now that it's been resolved. So some would say that we've got sort of a job half done and that we still need to stamp out inflation. Do you agree with that at all?
The honest answer is I don't know. I mean, just a month ago, people were saying that his massive acceleration in interest rates was literally ruining the economy. So it's like, okay, well, which is it? It strikes me that when inflation is coming down at this precipitous a rate, when you have what appeared to be some externalities or unintended consequences of this massive interest rate acceleration, a historic interest rate acceleration, that's saying we're going to take a pause until we have more data, that just seems infinitely reasonable to me.
Mm-hmm. Yeah. And something we were talking about a couple of weeks ago relating to interest rates is just this general sea change for investors. And, it might be an obvious point, but it's a point that needs to be made. And that is 2 years ago, you'd get a 0.5% yield on a 2-year treasury. And just across the economy, there was basically a near zero incentive to go into any fixed income investments. And today, a 2-year treasury gets you 4.7%. You can get a 1-year bond from Apple yielding 4.8%. And then you compare that to the S&P last year, which, accounting for dividend payments, returned negative 21%. So for the first time in more than a decade, it's like bonds are the new stocks. And, you've made this point before, but from an investing perspective, what are some of the main macro effects that you're seeing as a result of this non-zero interest rate environment? And have any of those effects in particular surprised you?
Well, the obvious one is what happened to Silicon Valley Bank. I don't think anyone saw that coming. And I don't know if that was a function of the massive interest rate acceleration or banking in a handheld world where you can get all of your capital out in about 3 minutes.
Right.
So there's no friction. There's no sleep on it, have to go to the bank. It's just like, you get an email from your VC, boom, I transfer all of my money from SVB to JP Morgan in 3 or 5 minutes. The impact on the economy might be when corporations and homeowners have to roll and refinance. I'm going to have to refinance the mortgage on my Florida house. I've got about a 2.5% mortgage. Actually, it's 2.375, I think. And that's likely going to increase to 5+%, which will increase my mortgage by, 50% plus.
Yep.
And I imagine there's just a lot of people that the doubling of their housing costs is really meaningful and will likely reduce their spend across other categories. So, this is, I don't know. I don't know if it's rolling in slowly and the economy is strong enough to absorb that. The shit you worry about is usually not the stuff that gets you. It's the stuff you're not worried about. And everyone's talking about the implosion of commercial real estate. And my guess is that's turning into another thing like this illusory recession that if we talk about it enough, banks will plan for it and try and give forbearance and just sort of slowly work it out, if you will, or entrepreneurs will step in with ideas for repurposing. I don't know. As a consumer, I had one of those moments where I have never owned a bond. I've just always been in stocks because, when I was younger, I had a much more aggressive risk profile, and I wanted to own investments that could double in value theoretically in 6 months. And the idea of owning a bond just seemed so boring and lame to me. And then over the last 10 years, as the idea of steady cash flow and diversifying or de-risking sounded good, you didn't get paid for it. I've been on boards. I remember I was on the board of Urban Outfitters, and we had a bunch of cash. So we were doing stock buybacks, and someone said, we can borrow money at like 2 or 2.5%. I'm like, well, just borrow money then. I mean, when I was running L2, and we took $15 or $20 million in venture funding from General Catalyst, Comerica showed up and said, we'll give you $5 million in venture debt because we follow tier 1 VCs around and offer a quarter of the initial principal invested in the form of venture debt. And the interest rate I had to pay on it was 3.25%. And so I said, send me the paperwork. And I signed it, and they wired in $5 million. And I did not need it. But when you have the opportunity to get $5 million for 3.25%, you take it. Now, the flip side of that is you don't invest when you're not getting paid for it. So I would never invest in a bond that had any risk at all, which everything does, except for maybe treasuries when you're getting not paid for it. I had some money. I had a big win recently, and the money got wired in, I don't know when it was, last week. And I immediately thought, I need to put it to work in something. I need to start figuring this out. And my guy who handles my account called me and goes, well, right now we just have it in, I think it was this treasury or 6-month treasury account, and it's yielding 5.4%. And I'm like, really? I'm getting 5.4% in what it appears to be fairly risk-free securities? He said, yeah. And I said, what was it last year? And he said, I think it was like 60 basis points or 30 basis points. So what it did for me was I immediately didn't feel a need to go out and try and find investments in stocks. So I would think, credit feels undervalued right now and stocks probably feel overvalued. Now, I don't know what that, when, stocks generally do really well in a low interest rate environment because bonds aren't as appealing. Now that bonds are really appealing, does that mean stocks are going to come down? I don't know. But it absolutely has changed my kind of investment complexion. For the first time, I own bonds. I own 6 months treasury. If someone had said to me, you're going to own 6-month T-bills, I would have said, okay, that means I have prostate cancer and I'm on a cruise. I mean, that just means, not that there's anything wrong with either of those things, but I own 6-month treasuries, and I like the idea of being more patient and opportunistic around if and when, shit gets real and I can swoop in and, buy a Gulfstream for $1 down.
So did you put the money in that treasury yield account?
Yeah, I did.
All of it, or are you?
Most of it, and I'm just going to wait. I'm just going to try and be more opportunistic and see what happens. And it's fun to have cash. I never have cash. I always thought put money to work. That's always been my mantra: put it to work, get it to work right away. In a company, a small company, investment, something, a stock. And this time I'm like, well, let's just wait till something really fun comes along or really interesting. Which is, anyways, it's a strange feeling. Right. The flip side is I got to refi a bunch of real estate at dramatically higher rates.